Aloha students, and welcome to the lecture on Chapter 3. This chapter we're going to be talking about a couple of topics, the balance sheet and financial disclosures. Okay, as you remember from your earlier accounting classes, the balance sheet reports a company's financial position on a particular date. So normally as of the end of the year, but it could be end of the month, could be end of the quarter. So the balance sheet, as we'll see in a second, lists the assets, liabilities, and stockholders' equity of a entity at a particular date. Notice that the balance sheet doesn't represent market values of an entity, as we remember from earlier chapters, that things are recorded on the balance sheet at historical cost. In other words, whatever it cost us, not the current market value. And there are certain things that may be valuable to a company that aren't recorded on the balance sheet because they're not considered accounting assets. Things like reputation of the company, their employees, the skills and experience of employees. Those are things that are not measured by accounting. So that's not recorded on the balance sheet. So the balance sheet basically shows the resources a company has for generating future cash flows. So that's what the assets are. Those are things that will generate revenues and cash for the company in the future. Provides liquidity information. Liquidity information is how quickly a company is able to pay its debts when they come due. And then it also provides information about the long-term solvency of a company. Long-term solvency basically is how can it stay in business in the long term? And that relates to the amount of liabilities in its capital structure. And we'll talk about that in subsequent chapters. Okay. The balance sheet, as I indicated, shows assets, liabilities, and stockholders' equity. And you remember from the accounting equation that assets equals liabilities and stockholders' equity. That's why you have the scale here that shows assets balance with liabilities and stockholders' equity. And again, that's the accounting equation. Here's an example of a balance sheet for Dell, the computer company, showing its assets. So notice that on this balance sheet, assets are shown in two separate groups. Current assets. Current assets are generally, as we'll see in the next slide, are considered to be those things that will be converted to cash or used up within a year. And then you list your long-term or non-current assets. Again, those assets that will last longer than a year. Notice we have a total assets column here. We also have a total current assets subtotal here. And this balance sheet just happens to be showing 2 years, the current year and prior year. Some companies show 3 years worth. Most, though, do show a comparison of this year with last year, kind of a thing. So here are some examples of current assets. Again, things that will be converted to cash or used up within a year, or the operating cycle, whichever is longer. And we'll see on the next slide what that means, but almost always it's a year. But examples of current assets are cash, cash equivalents, which are defined down here, certain kinds of investments that are very short term, that are negotiable. Negotiable means they can be sold at any time. Okay. Short-term investments, receivables, inventories, and prepaid expenses. We'll see all of these in subsequent chapters as well, but these are all examples of current assets. Okay, the concept of an operating cycle is basically the time it takes for a company to get raw materials or buy inventory So if it's a manufacturing company, converting those raw materials to finished products, then selling the products to the customer, and then collecting the cash. That's an operating cycle. In almost every case, a company, between the time they start the whole process and they sell the product and collect cash, that usually takes significantly less than a year. So 1 year is, remember our previous definition of current is converted to cash or used up within a year, or operating cycle, whichever is longer. So in almost all cases, this process here takes less than a year. So we consider current to be 1 year. There are some companies that it takes between the time they acquire raw materials and by the time they manufacture the product and sell it and collect cash, it's longer than a year. That's a very rare case though. So most of the time, the definition of current asset is less than a year. Non-current assets, so those are not going to be converted to cash or used up within 1 year. And here's some examples of those: investments, property, plant, and equipment, intangible assets, and other non-current assets. And again, we'll see those in a subsequent chapter. And here's some specific definitions for some of those categories of non-current assets. And again, we'll look at these in greater detail in subsequent chapters. Here's the portion of the balance sheet related to liabilities. And as you remember, liabilities are obligations to other entities, so amounts owed to other companies or other entities. So again, these are broken out into current liabilities, liabilities that have to be paid within a year, and long-term liabilities, those debts that are not due until more than a year from now. Current liabilities, again, basically what this is saying is they've got to be paid within a year. Examples of current liabilities are accounts payable, notes payable, accrued liabilities, unearned revenues, and current maturities of long-term debt. So even if a loan is due in, let's say, 10 years, if part of the payment of the debt needs to be done this year, so for example, those kinds of debts that you pay on a regular basis, you pay back the principal, then the amount of principal due this current year is a current maturity of long-term debt, and that's a current liability. Long-term liabilities are those that you don't have to pay until more than a year from now. So here's some examples of those: long-term notes, mortgages, long-term bonds, pension obligations, and lease obligations. We'll talk more about liabilities in subsequent chapters. So here's the balance sheet section related to stockholders' equity, or owner's equity, it's sometimes called. But it's called stockholders' equity for corporations because corporations issue stock. And again, we'll see the details of stockholders' equity in a subsequent chapter. Okay. This is a good time to talk about US GAAP versus IFRS. IFRS is the International Financial Reporting Standards. US GAAP, as you remember, are the rules of accounting that are used in the United States. Okay, so all US companies follow the rules that are made here in the US, and again, those are called GAAP. For almost every other country in the world, they use the International Financial Reporting Standards, IFRS. There are certain differences between The US GAAP, as created by FASB and IFRS, International Financial Reporting Standards. Some of the differences, as you can see, are the US GAAP doesn't really specify exactly what needs to be presented in the balance sheet. IFRS, on the other hand, does. Okay, they specify that certain things have to be on the balance sheet. Okay, US companies generally use the title balance sheet to represent the statement of financial position, is what the IFRS calls that financial statement that has the assets, liabilities, and stockholders' equity. US GAAP, the current assets and current liabilities are presented before the non-current. So remember from looking at the liabilities, for example, notice that the current liabilities are listed first and then the long-term liabilities. For IFRS, on the other hand, a lot of times, or most of the time, non-current assets are shown first before the current assets or current liabilities under IFRS. So here's an example. IFRS, as indicated in the previous slide, doesn't really specify what order the assets have to be in. But as you can see here, 75% of the companies list their non-current assets first. Non-current assets first, and then the current assets. Then they list the stockholders' equity, then the non-current liabilities, then the current liabilities. So they do it reverse of what US GAAP companies present. So that's a little different. Okay, the FASB and the IASB, International Accounting Standards Boards, they're working together to try to set common standards for everybody in the world to follow. And that process has been going on for some time now, and it's still in progress. So eventually, the US will be following some form of IFRS, but as of right now, there is no agreement on bringing those two different standards together. So that's still pending, still up in the air. Okay, the second major topic in this chapter is disclosures, sometimes called footnotes. Okay. These are explanatory statements after the financial statements that kind of expand on or explain things that are in the financial statements. Financial statements are just basically one line for each kind of item, and there's no explanation. Disclosure notes, footnotes, are where the explanations of things are. Things that it would be important for the reader of the financial statement to understand. The first disclosure, first footnote, is always summary of significant accounting policies. In that footnote, the company lists the different alternative accounting methods that they use. For example, depreciation. You remember that there's several different ways to do depreciation. There's straight line depreciation, double declining balance depreciation, some of the year's digits depreciation. So the companies have different choices. There was also different choices as far as valuing inventories. There was FIFO, LIFO, weighted average. So this footnote describes the different choices that a company made in the accounting methods they use, so that the reader of the financial statement knows which methods were used for the different accounting policies or accounting methods. Another important footnote or disclosure is the subsequent events. Subsequent events are things that happen after the end of the year that the financial statements present, but before the financial statements are actually issued to the public. So there's a gap there between the end of the year and when the financial statements for that year are actually finished, because it takes time to prepare those. So if something happens in between the end of the year and when the financial statements are issued that is significant, or that management feels the reader of the financial statement should know about or be aware of, those are described in the subsequent events section. Okay, and we'll talk about that in more detail when we go over the homework. And then noteworthy events and transactions. Whoops. Okay, so these are any other thing, transactions, events, okay, that are of importance to somebody reading the financial statement. Okay, there's a bunch of different kinds of things that could be disclosed, but anything that the reader of a financial statement would find important in looking at the financial statements should be indicated here in the disclosure notes section after subsequent events, basically. And again, we'll talk about this in greater detail when we go over the homework. Okay, but these are anything that is important for the reader of the financial statements to know about. Okay. There's also a section in the financial report besides the financial statements and the disclosure notes. There's a section called Management Discussion and Analysis. This is where management discusses or presents or talks about the company's operations, liquidity, the resources. This is where management talks about the financial condition of the company. Notice the description here says it's biased. Well, management prepares this analysis of its own financial condition. So of course, they're they're biased. Okay, they want to present their company in the best possible light. So they're only going to highlight good things or try to spin things to make themselves look better. Okay, but it is a useful piece of information to see what management is thinking about their own financial situation. Okay, and that's another separate section in a financial report. Okay, management's responsibility, we'll talk more about this later. So the annual report, as we just saw, contains the financial statements, disclosures, management discussions. So that's one of management's responsibilities, is preparing the financial statements. And then maintaining and assessing the company's internal control procedures is also important. Internal control procedures are steps, processes that assure or help to prevent errors or prevent defalcations and theft and that kind of a thing. Okay, and we'll discuss this in greater detail in a subsequent chapter as well. Okay, what steps does management have to prevent errors and to prevent misstatements in the financial statements? Those are internal control procedures. An important part of the process of issuing financial statements is an auditor's report. As you'll learn in auditing class, an auditor basically is an independent party that expresses an opinion about whether or not the financial statements are prepared in conformance with GAAP and if the financial statements are presented fairly. In other words, the financial statements are not all messed up. Okay, so the auditor checks the records, looks at transactions, and makes a determination as to whether or not the financial statements are fairly represented. Okay, The auditor is not saying the financial statements are perfect. All they're saying is it's fairly presented. So it's not totally messed up, in other words. Okay, there's various types of auditor opinions, which we won't go to in that much detail because you'll get to know these very well in auditing class. But there's 4 categories: unqualified. Unqualified opinions are the best possible opinion an auditor can render. Basically says the financial statements are fairly presented and the financial statements are in conformity with US GAAP. Okay, so unqualified is the best possible opinion. Qualified means the financial statements as a whole are fairly presented, but there's certain things that may not be correct or may not be in accordance with GAAP, or there's a couple of exceptions, but those exceptions are not so serious that it makes the whole financial statements messed up. Adverse, on the other hand, basically is an opinion saying the financial statements are not fair. They're not good. They're junk. Okay. Disclaimer of opinion is when an auditor is not able to do enough audit work to express an opinion. Basically, they're saying, we're not saying anything at all about this company, good or bad. That's a disclaimer. And again, you'll get more details about these auditor opinions later on in your career here at Chaminade in auditing class. Proxy statement. Proxy statements are generally a proxy basically is shareholders, as you remember, are able to vote on important corporate matters at a shareholder meeting. Okay, a proxy statement, a proxy is if you can't go to the shareholder meeting yourself, you give your vote, the right to your vote, to someone else. That's a proxy. And a proxy statement basically is something sent out by the corporation to the shareholders saying, here's when our meeting is, and if you can't be there in person but want to vote, then give your vote to us and we'll vote for you. That's a proxy statement. We'll talk about that later. Financial statement analyses. Okay, we're going to talk more about this in a subsequent chapter, but financial statements are obviously useful in analyzing a company. So there's various ways that various tools that we can use to analyze statements. Comparative financial statements are financial statements from year to year. So you can see how a company did this year versus last year, for example, if there's 2 years worth of financial information. So that's really important to show previous years. Yeah, so you can make comparisons. We're not going to get into these in that much detail because we'll talk about these in great deal later, but horizontal analysis. Horizontal analysis is just basically looking at the same item in a financial statement, for example, accounts receivable. You look at that particular account from year to year and see if the percentage changed at all during the year. So how much did that line item change from year to year? That's a horizontal analysis. A vertical analysis, on the other hand, is for a particular year, what percentage of the total is a particular line item. So for example, accounts receivable is 12% of the total assets. Cash is 35% of the total assets for that year. So you look at just a particular year, take the base, which is the total, and figure out for each line item what percentage of the total that line item is. And that's useful in making comparisons from year to year, as we'll see in subsequent chapters. And then ratio analysis is using different kinds of ratios to analyze the financial position of a company. And again, we'll get into this in more detail later on. Although there are, let me see if they present a few. Yeah, they present a couple of pages of ratios, so let's go through those. Important ratios, liquidity ratios are how able a company is to pay its short-term debts when they come due. Okay, so can they pay their current liabilities when they come due? What does a company need to have in order to pay their liabilities? They need to have basically cash or other current assets that can be converted to cash relatively quickly. So current ratio is calculated as the current assets divided by current liabilities. And this measures how much cushion a company has to pay its current liabilities. So how much more assets, current assets, does a company have than the current liabilities that it must pay? Obviously, this ratio has to be greater than 1. Okay, a company should have at least enough current assets to cover their current liabilities, but that's, without that results in no cushion at all. So the greater this ratio, the more able a company is to pay their liabilities as they come due. A ratio of less than 1 means they don't have enough assets to pay the liabilities when they come due. The acid test ratio is similar to the current ratio, except instead of the numerator being current assets, the numerator is quick assets. Quick assets are those assets that can really quickly be converted to cash. And as we'll see when we go through the homework, that's cash, short-term investments, and accounts receivable. Okay, those are things that within 30 days you can convert those to cash. Okay, so that's quick assets. So how much assets that can be converted to cash immediately does a company have to pay the liabilities when they come due? And again, these are both measures of liquidity. How able is a company to pay debts as they come due? A couple of financing ratios and that we'll see. Debt to equity ratio is your total liabilities divided by your stockholders' equity. That measures how much a company relies on loans, on debt, rather than owners. So remember, stockholders' equity is all the money that the stockholders contributed to the company, plus all of the net income that has been accumulating in the company. So this, again, total liabilities divided by stockholders' equity, debt to equity ratio, measures how much debt a company has. Obviously, the less debt a company has, the better off it is. So this ratio kind of gives an indication of that. And then times interest earned ratio is a specialized ratio. Net income plus your interest expense plus income taxes divided by interest expense. And this measures how much extra income a company has to pay the interest on its liabilities. So this ratio is of interest to people who lend money to a company. They want to make sure that they can get their interest as the interest comes due. So this ratio kind of gives an indication of how able a company will be to pay the interest when it comes due. So a company has to have enough net income, in other words, after paying income taxes. Okay. So it has to have enough money to pay the interest as it comes due. The more income they have, the more able they are to pay interest. So again, this is a ratio of interest to creditors, to people who lend money to companies. These are just some of the ratios that we will be seeing in this course and in Accounting 302. But these are just some of the examples of ratio analysis. See, we're not going to cover the appendix for operating segments. So that's basically it for chapter 3. The Zoom daily quiz. Let's see. My favorite spectator sport. Aloha.